Next to stage is our final speaker in the inefficient asset classes, Tim Carleton from Auscap. Tim's a CFA and CMT charter holder and has been managing long, short, large cap and mid cap portfolios with his team since 2007. We're delighted to announce today that GSFM is now the exclusive distribution partner for Auscap and look forward to introducing their proven quality value approach to Australian equities, including the newer X20 space. Ladies and gentlemen, Tim Carleton.
Thanks, Ben. Terrific to be here, and I'm doing my best impersonation of Mr. Burns from The Simpsons today because I was reminded on Sunday to stop throwing the kids around in the pool. We are absolutely delighted to have partnered with GSFM for the distribution of the funds on a go-forward basis. It's been a long interaction with the team, and we really look forward to dealing with them and all of you as we go forward. Today, we're here to try to convince you that in Australia there may well be an argument for active management. The debate and the trend towards passive management has been both persuasive and pervasive for the last decade. And that's no surprise, and it's reflected in the numbers. There's only 14% of US large cap managers that are outperforming the index over the last 10 years. The end result of that is last year alone there was $457 billion invested into passive equity strategies in the US, and $325 billion came out of active equities strategies. And so the question is, are US managers that bad? Or is there a reason that passive has performed so well in the US and that reason might not be replicated in other markets? Well, if we're to stand here 10 years ago and I was going to design an index that would outperform most active managers, the question is, what would that index look like? From a sector positioning basis, it might look like something like this. This is the S&P 500 in 2015. The largest sector exposure was the fast-growing technology companies. Not far behind, you had a reasonable exposure to financials, led by the likes of MasterCard and Visa. You had a healthy exposure to healthcare, led by groups like Johnson & Johnson and Eli Lilly. And you had quite a large exposure to consumer discretionary, led by companies like Amazon and Tesla. The common trait amongst all of those companies was that they would go on and deliver an extremely strong 10 years worth of earnings growth. In fact, if I was going to think about the top 10 investments over that period, I would have put together something that looked very similar to the top 10 investments that the US market had at that point in time. You already had 5 of the tech behemoths in the top 10. You had a global conglomerate run by one of the best managers the world's ever seen in Berkshire Hathaway. And you had other extremely strong performing companies like JP Morgan and Johnson & Johnson in the top 10. To such an extent that 7 of the top 10 delivered returns over that 10-year period that were multiples of the return of the broader market, led by Microsoft, whose return exceeded 1,200% over that period. So the best environment for passive investing might have looked like something like this, where more than 1/5 of your portfolio in 2015 was represented by these 10 companies. Those 10 companies would go on to deliver the returns that you see on the right-hand side. So if you think about active management in that context, how does active management outperform? Well, they need to pick stocks that are going to do better than these stocks on the right, or stocks, they need to be significantly overweight enough, these companies, that they deliver outperformance on a post-fee basis. The end result is very few managers have kept up, let alone beat the index. In fact, this group of 10 companies has been responsible for more than 35% of the increase in market cap in the S&P 500 over that period. So that's been a very difficult environment for active management. So if we invert the question and we ask, well, what would be the best possible environment for active management? What would be the best makeup of an index for active management? And the answer, undoubtedly, is an index that's full of low-growth, old-world companies that are facing new competitive threats and cyclical and structural challenges. In fact, you might go on to design an index that looks something like this. More than 50% of the All Ordinaries today is in just two sectors, the financial space and the materials space. And within that, the biggest individual exposures are within banking, the big four banks, and the big iron ore companies. So if we think about those two sectors on a go-forward basis, in our top 10 today, you have a 42% exposure to just 10 companies, and that includes the 5 banks and it includes the 2 resource companies. So if we just concentrate on those for a minute, the big banks have failed to grow earnings for 10 years. They've been facing an environment where they've seen rising costs as a result of IT costs, compliance costs, increasing capital requirements, and unfortunately, we don't think the go-forward is any better than the past. Why is that? Well, for the first time in a long time, they have a serious competitor. In the month of July, 39% of all loans written in Australia were written by Macquarie. Macquarie currently has a 6% market share in the mortgage market. So they are writing 6 to 7 times their market share in new loans as a share of the broader market. We think this trend is going to continue, and if you extrapolate their current rate of growth, they will comfortably go past ANZ and NAB inside the next decade. So suddenly you have these 4 companies that are now selling a commoditised product because they've outsourced the customer relationship. They've given that to the mortgage brokers. Well, all 3 other than CBA have. And so now they're competing against a lean and efficient Macquarie vehicle, who have a much higher ROE structure than they do. Why? They have a clean and brand new IT stack, and they don't have a legacy cost structure, starting with the most obvious cost in a business such as this: they don't have a branch network. So we hope, if we're 25% exposed to these 4 banks, that we're at least starting at a point of reasonable valuation. Unfortunately, the big 4 banks are collectively starting from the highest multiple of near-term earnings that we have seen since they listed. The next major exposure you're facing in the index is the iron ore majors. Steel demand in China looked like it peaked back in 2020, which is the 5th last little dot that you can see on the chart. This is steel consumption on a per-person basis. This is what accelerated development through time looks like. They haven't followed the normal path of every other developing country from a steel consumption perspective. But we are near certain that their steel consumption has peaked. It peaked 5 years ago, and we expect it to decline for the next couple of decades until it reverts back to what we see from every other developed world economy. Unfortunately, this is happening at exactly the wrong time. The 2 giant African deposits called Simandou are coming on stream in the next 12 months, and they're expected to put another 120 million tonnes into the broader market. For those of you hoping that there is some country that's going to save the day, namely India, unfortunately, the commodity market is about one country alone. This is what consuming 56% of the world's steel looks like on a chart. These are the biggest steel producers on the planet. You can see that China's production and consumption dwarfs all of the other countries. You have the rest of the world not on the chart down the bottom there. So unfortunately, India's rate of growth is not particularly relevant. You're fundamentally exposed to what happens to Chinese demand. So we have an environment in which you see demand, we think, weakening over time, supply increasing, and that's clearly not good for earnings. So where should you look? Is this an opportunity? Well, a lot of people recognise this, so they're going towards the small and micro end of the market. Unfortunately, we need to remember that the small ords is full of a whole lot of undesirable companies. There's a lot of cash-burning companies. There's a lot of materials companies that tend to consume more capital than produce it. You can see that nearly a quarter of the small ords is made up of the materials sector. And there are also a lot of fallen angels, companies that are on the decline over time, and they tend to be the biggest weight in the small ords. We think the real opportunity is in mid-caps, and this isn't a new opportunity. We've had the fortune of being heavily exposed to mid-caps over the duration of the last 13 years that we've been running the High Conviction Fund. And you can see the outperformance of the yellow line, which is the mid-cap 50. It's actually outperformed over every time horizon, 5, 10, 15, 20 and 25 years. The two blue lines are the ASX 20 and the All Ords, and the green line is the performance of the Small Ords. We think the real opportunity lies in the mid-cap space on a go-forward basis because it's very easy to explain that outperformance. Over time, we are true believers that the longer you stretch time, the more your total return becomes a function of two things and two things only. The capital that a business is returning to you through dividends or buybacks, and the earnings per share growth that you experience from those companies. As you stretch time, all of the other things, the geopolitics, the change in multiples, what's happening to interest rates, they fall by the wayside as being less important. If a company has grown earnings 1,000%, the stock will be up there or thereabouts. And the key driver of the mid-caps over that last 10-year period has clearly been the much stronger earnings per share growth that we've seen in that space than you've seen in the other markets. It's driven the stronger total returns at the bottom line. We don't think this is going to change on a go-forward basis. There are more active managers outperforming in mids and smalls in Australia than any other part of the market, so it pays to have someone that is selecting the right stocks. We think the next 10 years is probably going to be a golden period for active management in this country as long as you have a genuine active manager in your portfolio. Thanks.